Welcome to FactWire Report, your calm, ad-safe briefing on technology, markets, and policy shaping the week. Today, OpenAI unveils an AI-first browser. Washington announces energy sector measures on major Russian oil companies, and markets track the ripple effects. We keep language neutral, facts fresh, and sources verified within the last 72 hours. Let's begin. OpenAI has launched ChatGPT Atlas, a new web browser built around its chatbot and designed to streamline how people read, research, and act online. Atlas debuts on macOS with a ChatGPT sidebar that can summarize pages, compare products, and analyze information without switching tabs. A preview agent mode for paid tiers can carry out multi-step tasks, such as planning trips or handling shopping flows, while broader Windows, iOS, and Android releases are slated next. The move positions Atlas as a direct challenge to Chrome and other AI-enhanced browsers, and could shift how users discover information if ad-supported experiences arrive later. OpenAI emphasizes user controls for data and memory settings. Up next, a major policy move with market ripples. Washington announces new energy sector measures, and traders quickly reprice risk. The United States announced new measures targeting Russian energy majors Rosneft and Lukoil, marking the first such Russia-related action of the current U.S. administration's second term. The steps arrive alongside European moves restricting Russian LNG and quickly fed into prices. Brent and WTI jumped more than 4% as traders assessed supply pathways and potential secondary effects. Analysts say effectiveness will hinge on enforcement and buyer responses, particularly in Asia. Officials framed the action as part of a sustained approach rather than a one-off move. We will monitor how exemptions, timelines, and compliance guidance evolve and what that means for shipping, finance, and refined product flows. Coming up, earnings meet policy, how corporate results and guidance intersect with shifting incentives and consumer demand. Tesla posted record quarterly revenue, yet profits slipped below expectations as the U.S. EV tax credit phase-out trimmed margins and deliveries. Revenue rose 11% year-on-year, but operating income declined 6%, with CEO Elon Musk citing cost pressures from new gigafactory ramp-ups. Analysts noted that while global EV demand remains firm, pricing discipline has tightened and incentives in Europe and Asia are shifting. Investors reacted cautiously. Shares edged down 3% in after-hours trading. Tesla reaffirmed its long-term production targets but warned that tax credit changes and logistics costs could temper U.S. growth in early 2026. The results underscore the EV industry's transition from rapid expansion to margin management. Next, from corporate numbers to market signals, why bond yields are sending investors a clearer message. U.S. Treasury yields fell sharply after Federal Reserve Chair Jerome Powell's remarks hinted that policy rates are sufficiently restrictive. The 10-year note dropped nearly 30 basis points to its lowest in 2 months, while stocks gained as bond traders interpreted the message as a pause signal. Market-implied probabilities now suggest rate cuts starting in early 2026 if inflation continues to ease. Analysts cautioned that liquidity flows and foreign demand are amplifying moves. The shift underscores a broader repricing of risk as investors weigh slower growth against easing policy. Benchmark yields remain well above pandemic-era lows, but the momentum shows how quickly expectations adjust. Still ahead, Washington and Beijing in focus again as software trade rules return to the table. The U.S. is weighing broad export restrictions on products made with American software, a move officials frame as a response to China's recent rare earth export measures. Options under discussion range from targeted controls to sweeping limits that could touch items from laptops to jet engine components, and would likely require coordination with G7 partners and detailed enforcement guidance. Business groups warned that complex supply chains and compliance costs could hit U.S. firms unless rules are narrowly scoped and phased in. Markets treated the trial balloon as another sign of tighter tech trade governance, pending interagency review and potential exemptions for safety or humanitarian uses. Timing and scope remain undecided as talks continue. Next, A domestic policy wrinkle: how shutdown-related firings could slow place-based investment programs. Mass firings during the ongoing U.S. government shutdown could impede implementation of two centerpiece community investment incentives made permanent in President Trump's tax law: new markets tax credits and opportunity zones. Court action has paused some dismissals, including at the CDFI fund, but uncertainty threatens certifications, allocations, and pipeline deals that channel private capital into low-income areas nationwide. Former officials and lawmakers across parties cautioned that reduced staffing may delay billions in projects unless agencies regain capacity quickly. Treasury and the White House declined comment. The episode highlights how administrative bandwidth, not just statute, determines real-world outcomes for long-running economic development tools. Ahead, the inflation debate. Are price pressures easing or settling at a higher baseline for longer? Fresh economic data suggests the U.S. is settling into a period of structurally higher inflation, even as headline measures ease. Core PCE and services CPI remain sticky above 3%, while wage growth continues near 4%, reflecting persistent labor tightness and housing service costs. Economists note that rather than a re-acceleration, this points to a new equilibrium: slower but more durable price pressures. Market pricing now implies long-run rates above 2.5%, and investors are watching whether the Fed will accept modestly higher inflation or tighten again. Fiscal incentives and energy transitions add complexity, reinforcing views that lowflation of the 2010s is unlikely to return soon. Next, volatility returns as markets face their traditional autumn test of confidence. Stocks fell sharply in a broad sell-off dubbed Red October, with investors rotating into defensives amid global growth uncertainty. The S&P 500 slid for 2.4% for the day, its largest drop since April, while the Nasdaq fell 3.1%. Bond rallies and safe haven flows pushed the dollar and gold higher. Strategists link the move to quarter-end positioning and ETF redemptions rather than new systemic stress. Still, volatility indexes spiked, reminding traders how tight liquidity can magnify routine swings. Most expect consolidation before earnings season picks up again. October's pattern reflects a healthy risk reset after months of momentum trades, rather than a signal of broader panic. Up next, AI meets law: how a new partnership could reshape legal research worldwide. Swiss AI research firm DeepJudge announced a strategic partnership with Thomson Reuters to develop the next generation of AI-powered legal research tools. The initiative combines DeepJudge's language model expertise with Thomson Reuters' extensive Westlaw and practical law databases, aiming to deliver context-aware answers and citation precision for lawyers and corporate counsel. A joint API framework will let enterprise clients integrate verified legal AI into existing platforms while maintaining confidentiality and audit control. Both companies stress transparency, ethics, and human-in-the-loop review as core principles. The collaboration reflects broader industry momentum towards specialized AI that augments, not replaces, professional expertise. Pilot programs in Europe and North America are scheduled for early 2026. Finally, policy meets technology again as Washington weighs broader software curbs on China. The White House confirmed that Washington is considering broader software export curbs on China, aligning with ongoing reviews by the Commerce and Treasury departments. Officials framed the process as strategic calibration rather than a new sanctions wave. Bloomberg reports the effort builds on previous U.S. rules restricting advanced AI chip exports and may cover development tools or cloud infrastructure licensed through U.S. entities. Markets read the statement as signaling steady tech containment, but no imminent ban. Analysts expect a draft policy outline by year-end, followed by industry consultations. Officials reiterated that measures will focus on national security and transparency while avoiding broader supply chain shocks. That's all for today on FactWire Report, where AI, economy, and policy intersect. Stay informed, stay grounded, and we'll see you tomorrow with verified updates from around the world. Thanks for watching.